We will continue with our investment decision chapter. Today we will see investment criteria. Investment criteria. Under that, payback method, ARR method, net present value, IRR method, profitability index. We'll see that. What is investment criteria? Criteria means standards on which something judged. That is criteria. Criteria means standards on which something judged, or you can say it is a benchmark. Or you can say a yardstick. Or standards on which something judged. Investment criteria means the technique is used for the selecting the which project is better in terms of returning the amount. So it is a techniques. It is known as a capital budgeting techniques. Using these techniques, we will come to which project is a better one. For example, you may have project A, project B, project C, project D, out of which you will select, whether you select A, whether you select B, whether you select C, whether you select D. You will not select A, you will not select B, you will not select C, you will select C, D. What is the reason for selection? What is the reason for the selection? The simple reason is maximum return. The question is how you measure this one, maximum return, using the techniques, capital budgeting techniques. In this we have two types capital budgeting techniques. We have two types of capital budgeting techniques. One is traditional technique, or you can say non-discounting. Another one is time adjusted, or discounted cash flows. Discounted cash flows. Under the traditional, we will see payback period. Number 2, ARR. It is known as average rate of return or accounting rate of return. Both are correct. Accounting rate of return or average rate of return. Under this discounted cash flow, first one is NPV, net present value. Next comes PI, profitability index. Next comes IRR, internal rate of return. Next comes MIRR, modified internal rate of return. Modified internal rate of return. Last one, discounted payback. So these are the two types, traditional and discounted cash flows. Now we will see payback period. Payback period. Payback period means how much time is required to recover the initial cash outflow. What is the time is required in order to recover your initial cash outflow? Is called payback period. So you will know the initial cash outflow, that is as on today. You will have the cash outflow at the end of if it is a project of 4 years you will get year by year, that is called cash inflow. So whatever the cash time is required for your recovery of the cash inflow, it is known as a recovery of your cash outflow, that is known as a payback period. For example, see, initial outflow, that is today, now, is, let's say, rupees 15 crore. Let's say your project life is 5 years. Your project life is, let's say, 6 years. 6 years. This is a project life, that is expected cash inflows will be in a 6 years. Each year, let's say each year you will get cash inflow is rupees 3 crore. So how many years you will recover the 15 crore? year 1, 2, 3, 4, 5, 6 6 years project. Cash inflow 3, 3, 3, 3, 3, 3. Cash outflow 15. So 15, where will be the 15? At the time of 0, now, today. This is a cash outflow. You will receive 3 here, 3, 6, 9, 12, 15. At the year end of the 5th year, you will recover the amount. Here it will be 15 crores. How? 3, second year cumulative 6, you will receive 9, 12. At the end of 5th year, your total amount is recovered. Cash outflow is recovered. So payback period is, in this case, 5 years. That is called payback period. See, your profit before tax, one amount. From this you will deduct tax. So you will get amount profit after tax. But what we are doing, cash inflows, cash. So in order to cash, we have to add back depreciation. Why depreciation to be add back? Depreciation is a non-cash expenditure. We deduct the expenditure here. It will come in a expenditure. We have to deduct all the expenditure in order to arrive at profit before tax, right? From the income you will deduct all the expenditure, then you will arrive at profit before tax. But depreciation also included in expenditure. This depreciation also included in a expenditure. But these depreciations are non-cash, only book adjustment. What is the depreciation? Depreciation is the charged on the fixed asset. Depreciation, reduction in the value of the fixed asset. It is not a cash outflow, it is just a expenditure. So it is not actually cash is gone, not outflow. It should be added back. So depreciation should be added back. So this amount should be considered for your cash inflows, not this amount, not profit after tax, this one. You have to add profit after tax, you have to add depreciation. That should be considered for cash inflows. So that is a payback period. So capital budgeting techniques, we have two types, traditional and discounting. Traditional or it is also called as non-discounting. Under non-discounting, payback period, ARR. Under discounting, NPV, PI, IRR, MIR, discounted payback. So payback period means time required to recover the initial cash outflow. It is called payback period. So what is the payback period formula? Total initial capital investment divided by annual expected after tax net cash flow. see here, you deduct cash from the tax from the profit before tax, then we have to add back depreciation. This cash flow 4 lakhs to be considered. Let's say your project cash outflow is 20 lakh. Okay, tax is 50 percentage. Profit before tax is 3 lakhs. So 3 lakh minus tax 50 percentage, you will arrive at profit after tax. You have to add back depreciation. Depreciation has to be add back. Depreciation on what? This project, 20 lakhs into depreciation, that should be added back. So you will get cash inflow. So total investment divided by cash inflow, you will get payback period. Another example, this is a company, their cash inflows are there. At the beginning, cash outflow is a 2 lakh. This is the end of the 1 year, 80,000 received, 60,000 received, third year 60,000 received, 20,000 received. So what is the payback period? This 2 lakh has to be recovered. 80 plus 60 plus 60 plus 20. So 80 plus 60, 1 lakh 40 plus 60, 2 lakh plus 20, 2 lakh 20. So we can see payback period is 3 years. Within 3 years it is recovered. Hence payback period is 3 years. Our investment 2 lakh is recovered in 3 years. 20,000 is a profit. Let's say cash outflow is 2 lakh 5,000. Same case, 2 lakh 5,000 your cash outflow at the beginning. So same thing you have to do, 80,000, 1 lakh 40, 2 lakh 20,000. Now the thing is, you have to recover only 5,000. 5,000 has to be recovered, not 20,000. So what you have to do? At the 4th year you recovered 20,000. Fourth year cash inflow is 20,000. Your cash outflow 2 lakh 5,000. Till third year you recovered cumulatively 2 lakh. So you have to recover 5,000, at least 5,000 you have to record in order to calculate payback period. How much you have to recover? 5,000. So from 2 lakh to 5,000. So 20,000 fourth year. This is calculated for one whole year. We require 5,000 in order to calculate payback period. So what is the time period? So 5,000 divided by 20,000, 5,000 into 1 divided by 20,000, you will get 1/4 year. So this can be converted into 3 months. So your payback period will be 3 years you need to recover plus 3 months. That is what they explained here. Payback period shall lie between 3 to 4 years, correct? 3 to 4 years, because it is a 2 lakh 5,000 investment. Since up to 3 years a sum of 2 lakh shall be recovered, balance 5,000 shall be recovered in the part fraction of 4th year. Computation is as follows: 5,000 divided by 20,000, so 1/4 year. Thus total cash outlay is 2 lakh 5,000 shall be recovered in the 3.25 years. What are the advantages of payback period? It is easy to compute. No need to put a factor, discounting factor and all. Easy to compute. It is easy to understand. It provides quick estimate for the time needed for the organization to recoup the cash invested. The length of payback period can also serve as estimate of project risk. What is the project risk? Whether the longer the payback period, the longer the risk. Like that, it can estimate. But what is the major limitations? It ignores the time value of money. It ignores the time value of the money. In this case, we said we will receive 3 crore first year, 3 crore second year, 3 crore third year, but this 3 crore whatever is received in a first year, end of the first year, second year, third year, is it the same value of today as on today? No, it value of money decreases, so we have to apply discounting factor. That is called discounting factor, time value of money. So it ignores the time value of money as long as the payback period for two projects are the same. The payback period technique consider them equal as the investment. Even if one project generates the most of its net cash inflows in the early years of the project, while the other project generates most of its net cash inflows the latter years of the payback period. The second limitation of this technique is failure to consider the investment's total profitability. It only considers the cash inflows up to the period in which initial investment is fully recovered and ignores the cash flows after the payback period. Correct, right? We consider only whatever received up to 2,05,000. This is the 3.25 years. What about the others? We require the profit. How many years we can generate? What are the other period? That is very important. But this is a very much limitation of the payback period. Last one, payback technique places much emphasis on short payback periods, thereby ignoring the long-term projects. Correct.